So why do good companies, companies with amazing fundamentals, companies with large market caps, companies that some people regard as blue chips, companies that have been there and have stood the test of time, why do companies go down? Why do they experience volatility? Check this video out. Hi everyone, this is Marvin Germo. If you're new to this channel, subscribe. We're now at the 48,300 mark. We're close to our target of 50,000. The road to 50,000 is almost complete. Smash that bell also so you get updated every time I create new content about the stock market. Lately, I've been doing more than one video a day because I just want to create as much value to you guys as possible. So enjoy the rest of the video. So guys, it's 11:30 p.m. It's almost midnight. I'm just done with my stock market sessions here in Singapore. It's our first night for all of our sessions. It's my second night here. But what's interesting is there was a lot of volatility today. A lot of the large cap stocks, a lot of those fundamentally sound companies started to go down. Then I got hundreds of messages, Facebook, Instagram, my website, YouTube, asking why are those companies down? Technical indicators are still up. A lot of them are still bullish. What, they have amazing fundamentals. Why did they go down? Why was there a large surge of selling on those stocks? And it's been a time question that I would normally get. Why do good companies go down? Shouldn't they just go up because they're fundamentally sound? Shouldn't they just go up continually because they are amazing to begin with? So let's start with this. First things first, all stocks, regardless of their fundamentals, all stocks, regardless of how good they are, regardless even if they have the best CEOs, best chairmen of the board, best leadership, they have amazing growth prospects, amazing dividends, they will always retract, they will always retrace, they will always go down. It's impossible for stocks to go up in a straight line. It's impossible for companies, regardless of what you see in them, it's impossible for them to never go down. It's impossible for them to just break out continually and never fall. You have to remember it's part of the game. That's why I keep telling people, if you are invested in the market, you are investing in stocks, it always has to come to a point that you have to know that at any given point in time, the stock that you have could possibly go down, could possibly retrace, because it's part of the game. It's part of how markets work. Why? Please remember this, and I've made a ton of videos about this already, and I talk more about this in our technical analysis courses, but basically this: more buyers bring the prices up, more sellers bring the prices down. So what does that mean? There will come a point in time now that good company hits a point where it becomes cheap. It comes to a point where it becomes too cheap to ignore. When it becomes too cheap to ignore, a lot of people start buying. When a lot of people start buying, more buyers bring the prices up. Now, here's the thing, here's the narrative. When more people buy it, it goes up. The same people who bought it that are now earning a lot of money from the time that they bought it. Please remember, we all have different timelines. Some people are just willing to hold it for a short amount of time. Some people will need to sell it also because they would want to transfer to another stock. Some people will just bluntly sell it because their goal has been achieved, or their goal for putting money in the market has been achieved already, meaning they need it for a college fund, they need it for business, they need it for some underlying measure that they would need capital, and the earnings that they would have in the market is already substantial, that when they sell, it will already fund that particular goal. So that being said, when a lot of investors sell, it will always go down. There will come a point in time where people will need to take profits no matter how good it is. So one reason is it's just normal common sense. It's just normal logic that people will just normally sell. People will just normally take profits. People will just normally take out some of their gains. That's one. Number two, and another reason is, especially for large cap stocks, you have to remember the notion that majority of the people invested in our market, majority of the investors are mostly, number one, foreign investors, number two, mostly institutions. For foreign investors, their narrative is they're basically driven by, if the market in the Philippines is higher already, the valuations are higher already, meaning the next option for them is basically to transfer and go to another market where it's cheaper. Please remember, in the grand scheme of things, just looking at Southeast Asia, we're not the only markets here. You have Vietnam, you have Indonesia, you have Thailand, which has almost the same demographic as us, almost the same growth, almost the same population. So it's just a matter of, are we cheaper than everyone else? Because if we're more expensive, the common narrative is they can transfer to those countries as well. The same thing also for some funds, meaning some funds also, even local funds, will have to reallocate, will have to reposition, will also have to shift depending on the goal of the funds that they have as well. So why am I saying this? When it comes to a point where the stocks that they have are over allocated already, or meaning they need to sell some of it to lighten up, they're gonna do it as well. And one of the reasons why also stocks retrace, why do they also go down, is it comes to a point where I'm now speaking in terms of valuations, that some of the stocks already have hit what their value is already for the year. So meaning for some people who have just 1 year timelines, when those valuations have been hit already, it's a normal scenario, it's a normal, and it's normal for them to take profits, because why would they want to hold on to a stock that's already overvalued? That's why tomorrow I'm actually excited for our valuation session here in Singapore as well, because we will teach you how you can compute for the fair value of the stock. So just a quick plug, no, tomorrow is day 2 of StockSmart's valuations, and day 3 is Friday, then Saturday, Sunday we have our technical analysis sessions as well. For those who don't know about it yet, I'll put the link is in the description, or just comment Singapore. I'll give you the link on how you can join us for our Singapore sessions. But the last 2 events that I will have for the year will be in Davao, November 30, and StockSmart's Manila, November 23, 24, all leading all the way up to December as well. So that being said, when valuations get hit, when stocks hit their fair value, they're already overpriced. It's normal for people who own the stock to actually sell. So that's another trigger also. And why do some stocks also go down? Please remember this, no matter how good it is, if there is uncertainty, not just in local markets, but there's uncertainty also in foreign markets, it's just a common narrative for people to sell, because they want to what? Not just preserve their capital, they want to stay in the sidelines first until they see something shift, until they see the uncertainty to be out of the window. Please remember, cash to a lot of investors is also a position, meaning it allows them to have options should the market drop further later on. They have may bala, kumbaga, or when it's up already, they just want to lighten up already and take some of the profits and use some of those cash later on when the market starts to drop as well. So that's also a narrative, that's also a possibility, and a lot of people also do that. Another reason why markets drop, please remember this, resistances. When stocks hit resistances, and I'm talking about technical analysis already, when stocks hit resistances, when they fail to break out from those strong resistances, you have to remember, when you plot your resistance lines, certain stocks will hit those long-term resistance lines and they cannot break it. Having a hard time, when stocks have a hard time breaking those resistances, no matter how good the story is, no matter how good the narrative is, no matter how good the fundamentals is, those stocks will drop, those stocks will correct, those stocks will go down. That's why you shouldn't be sad, you shouldn't be lonely when you see stocks drop like that, because it's part of the game. What you need to ask yourself though, what should you be doing while those stocks are going down? That's why I keep stressing it. If you're a trader, when stocks hit those resistances, you need to sell. I repeat, when stocks hit those resistances, you need to sell, you need to take profits, you need to get out. When if you're using moving averages, when those signals to sell also get out, you need to sell. That's why you need to be emotionless when things like that will happen. That's a very, 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 very key distinctive, that when you see all of those things come into motion, you sell, you take profits. Or if your target also is you to make money via valuations, when it's already hit its value, you need to sell, you need to get out, you need to take profits as well. Or in the same way, if the company's fundamentals change already, no matter how long you've been holding on to it, no matter how nostalgic you are with the brand, you have to sell, you have to take profits, you have to get out of that position. That's why in the stock market, and I've been creating so much videos about this, it's all about emotion. That's why you should not rely on your emotion every time you see stocks start to drop. You must rely on what your signals are, because at the end of the day, no matter how good the company is, they will always drop down, they will always succumb to a very narrative that a lot of people won't buy it already because it's higher. Another notion though that I haven't mentioned is, there are a lot of people, a lot of investors, a lot of funds also who buy stocks because of the dividends that they receive. Meaning, when a stock becomes too high, the dividend yield becomes too low. If the dividend yield becomes too low, then it's not as attractive for them anymore to pick up. Please remember this, when even if a stock is good, if it's too expensive, a lot of people shy away and they don't buy. If a lot of people shy away, and they don't buy, you know what's gonna happen when they shy away and they don't buy? More people that are not buying, or less people buying, bring the prices down, because meaning people who own the stock will have to sell lower. That's just how it is. Please remember, and I keep saying this all the time, I have to repeat this over and over. When people sell, when a lot of people sell, no matter what the narrative is, they're selling because they want to go lower, there's bad news, there's something happening in foreign markets, there's a better storyline elsewhere, it's already overvalued, it's already overpriced, it's not as cheap anymore, the stock will go down. And that's what's happening. That's a normal progression. So another approach that you can do is this: if you're a long-term investor and you see volatility, but the company is still good, you can make a decision. You just stay the course. Stay the course, don't do anything. But when you have cash, as it starts to correct and hit those areas where it becomes cheap again, or it hits those support levels, you can use that as an opportunity to buy. So please remember this: you don't have to listen to what every scenario that's out there. What's so important, because I know there's a deluge of information already out there. You can learn from so many sources, but at the end of the day, ultimately, it's you who's pulling the trigger. It's you who has to decide whether you will buy, whether you will sell, whether you need to take action. So at the end of the day, when the stock starts to retrace, it's you ultimately who will need to make a decision whether you should sell. For those who are trading, you have to make a decision: do I sell after one red candle failing to break the resistance? Do I sell if the red candle, I'll give it 2 or 3 more red candles so that I have confirmation before I see that it's a good time already to take profits. It's you who can define that. You cannot base that on someone else. You cannot base that on what other people will say. That's why I keep stressing it here. You need to base your narrative. You need to base your trading based on who you are, based on your risk tolerance, based on your strategy. And you can only do that via technicals or fundamental analysis. You cannot guess, you cannot speculate, because at the end of the day, the way for you to win is to be able to create and forge a strategy based on all of that as well. So just to summarize all of this, it's normal for companies. My hair, I need to fix it because I own a barbershop. My hair should be nice. So what's the narrative? Number one, it's normal for companies, no matter if they're good or bad, big or small, growing, not growing, to retrace, because when more sellers surface, the stock will go down. It's normal for companies, even if they're good, because it comes to a point in time where sellers overwhelm buyers, where they hit the resistance or they become overvalued, that people will have to sell it. So for those who are a bit scared when they see their stocks go down, my suggestion is this: you only expose yourself to an amount of money that if markets drop, you wouldn't be so scared, because the amount of money that you put there is something that you can tolerate. We get scared when we see stocks drop because we're exposing an amount of money that hindi natin kaya tolerate. And that's very, very important. And that's been my rule of thumb. That's what I've been sharing through the years. You only put an amount of money in the market that if it drops, you're supposed to be okay as well. So please remember also, I'll stress this over and over, that while, for example, 100,000 for you is too much already. If it goes down 10%, you cannot sleep with a 10,000 peso loss. But please remember, at 100,000 today, it may seem big for you, but 5 years down the road, it may be small already for you. Why? Because your experience gets better, your skills gets better, and not just that, your portfolio also gets bigger, and larger exposure to the market will somehow increase your tolerance. And that's what I want to do to all of you. These videos are done daily to urge you, to push you to be exposed more, so that you just don't invest just based on this, just because someone said it's volatile, just because someone said it's scary. But I want you to be in the trenches. Iba yung nararamdaman mo bumabagsak yung stock, because it builds the confidence, it builds the conviction, it builds the skill. And I don't want you to be just headline readers. I don't want you to just see it because it's what's happening. I want you to experience it. Iba yung na-experience mong bumabagsak yung stock and you live to tell the story. Because if you live to tell the story, the skill will develop. It's not a question whether stocks go down. It's a question of what you're doing when they're going down. It's not a question whether stocks will retrace. It's a question of, while they're retracing, while they're going down, are you the one who's in cash and waiting for it to just bounce back again? Or are you the one who's also waiting that, I'm okay. This is a fundamentally sound company. I don't have to do anything. At the end of the day, the choice is yours. At the end of the day, the only way for you to win is to build a strategy around it and have the conviction to execute. This is Marvin Gurmo. Almost midnight, but I hope this video helps you trade well, trade strong, trade smart. See you all again soon, guys, and God bless you all.